So let's move on. Let's look at ourselves. Because we can't change what's happening in the market. We can look at the data, but how we react to the data is a personal thing. And one thing that I've really noticed lately, I'm studying for the CFA exam. Hopefully this is my last year. There's 3 levels. You can only take 1 test a year. And each level gets harder and harder. Level 3, though, whether I pass it or not, I've learned so much this year that I would love to pass it. My wife would really love me to pass it, so she gets me back. But one of the things that level 3 really hammered on is this thing called behavioral finance. And it's really starting to kind of pull back the curtain on how the investing world works. Because Wall Street has drilled into all of our heads, whether it's our regulators, whether it's the Wall Street bankers, mutual funds, they've all told us things. And they're based on one simple fact. Investors are rational. How many of you are rational when it comes to your money? I don't know anybody that's 100% rational. Some people have a couple biases. Some people are completely irrational, but that's fine. That's human nature. The first reading I had in my CFA Level 3 stuff was talking about this thing called behavioral finance. Behavioral finance is new within the last 10 years. And it says, this is how investors have behaved. And how can you overcome it? Instead of saying, you're an idiot for not doing what you're supposed to do, instead of criticizing you for being human and sometimes being irrational, it says this is how you have behaved and here's how you overcome it. So here's some of the biases that they've identified. And there will be a quiz before you leave, otherwise you're going to be spending the night here in a snowstorm. Now, we'll go over some of these, but I just want to show you how many biases, and there's even more than this, that we are prone to as investors. These play a role in everyday life as well, but as investors, these things come into play. Let's talk about a few of them. During a bull market, we see specific biases that are developed. Market's going up, you have dips, but then it rallies back up, and so you start to see some biases. Conservatism, not adapting to new information. I see this happening a lot over the last 6 months. Some of that new information includes corporate earnings are declining, profit margins are declining. Both of those things typically happen before a bear market starts, not after, before a bear market starts. They're a warning sign. Most people aren't paying attention to that. Another piece of new information. What did the Federal Reserve announce they were doing in December for the first time since 2006? They raised interest rates. This entire bull market until right here, that was all with the Fed stimulating the economy. New information. The Fed almost always taps the brakes too hard, throws our economy into a recession. The stock market, on average, loses 40% just before and during a recession. New information. People are jumping in. They see the market's going up and they say, hey, everything's fine. Look, they're ignoring this new information. They're ignoring the fact that earnings are going down. I'll never forget, April 2000 was one of the best earnings seasons I've seen, and yet the market, with hindsight, had already peaked in March. You move over to confirmation bias. People only seek out things that confirm their viewpoints. I am extremely susceptible to confirmation bias. I think a lot of us can be. I know that, so I try to overcome it. Peter might give me the nickname of Mr. Sunshine, but if I find myself being overly pessimistic, I will force myself to go to Market Watch, USA Today, CNN Money, those things, those really, if you, Motley Fool, Yahoo, those things that tend to be very, very optimistic. I'm going to read that and I go into it saying, what in the world am I missing? Why am I leaning so far this way? Sometimes I find it and say, okay, I need to move back to the middle. Sometimes I say, I don't see anything that these people are saying that makes sense. Good example, social media. This is, you'd think with technology and the availability of information, we would have much more informed people, but we tend to just go towards the people that confirm our beliefs. Because I tend to be right down the middle, I'm probably the most unfriended person on social media. I offend the liberals, they call me a right-wing nut job. I offend the conservatives, they call me a socialist. They don't like that I will point out the other side of their argument, so they unfriend me or they block me so they don't have to hear it. My son-in-law is just extremely smart, and he is, for a 23-year-old, I can't get over how wise he is. His mom has to be the most right-wing person I've ever met. Now, he's a conservative, but he's a little bit less right than her. And it's so funny to see him interact with her on social media. She'll post something, talking about the end of the world that's happening because of politics. And he'll say, Mom, this article's from 2002. Or Mom, how about you check Snopes and know this is 100% not true. But we need that. We need to check ourselves and say, are we leaning one way too far? Listen to the other viewpoint. If you're too optimistic, read my blog. Just kidding. And if you look at my blog earlier in 2016, I was pointing out the bright side because I know our advisors. They come to us when the market's dropping a lot, and I want to say, don't overreact. Calm down. Here's the positives that are going on. Don't just rush to cash after the market drops 12%. But if it's at valuations that tell us expect 0 to 5%, I'm going to be the other side of that argument, saying, here's the things you should be careful of. I want to be there to avoid that confirmation bias. You move on to representativeness. We see this all the time. People keep trying to line up what's happening now and saying, well, it's like this period here. I see this all the time on Market Watch and those things where I go to basically say, what am I missing? Why am I too pessimistic? And the number one thing they say is, well, we don't have a housing bubble, therefore, we aren't in danger of going through another crash. We saw the same thing in 2006, 2007. They said, look, the PE ratio is half what it was in 2000. They're trying to match it up exactly to what happened, so it gives them another bias, which is the illusion of control. I'll see it when it happens. I'll be able to get out in time. We had so many people that last fall jumped into the market and then called us after the market dropped 12% the first 4 weeks of 2016 and said, why in the world did the market go down so fast? You think you can get out, but bear markets happen so fast. This lulls us into a sense of complacency, thinking, well, it'll go down and it bounces back, and I'll know when to get out. And then finally, the bias that we actually started talking about when I started with strategic equity, we called it recency bias. What the behavioral psychologists call it is availability bias, which basically is how our brains work. We're programmed to recall the most recently available information first. In addition, if you have those major shocks or those major emotional things that happen, maybe it's you remember doubling your money in some tech stock. That's going to stay more available in your brain. Or if you went through a 2008 and you lost half your money 2 years before you retired, that's going to be stuck in your brain as well. So your brains will recall the most recently available stuff. It'll recall the most memorable things and then ignore all the other data around you. The beauty of all these biases, though, they're all cognitive errors. Cognitive errors are things that's just errors in the way we're processing information. Therefore, we can look at the data. We can go to MarketWatch or SEMTradersblog.com or wherever you need to go, get different information. You could do what I've been doing on social media, and you could post data from the Federal Reserve website and say, make up your mind with the data. Let's stop trying to make sure it matches 2008 and saying we're okay, we can get out in time. Let's look at the data. Those charts I showed you with the regression lines, that's data. Cognitive errors can be overcome with data. What's really hard, though, is the long-term biases that develop that are behavioral, they're emotional. During these periods where you get really big run-ups in stocks followed by really big drops, these are the biases that happen. Hindsight is the only one on this list that's a cognitive error. It's similar to recency bias and the illusion of control, where you say, oh my gosh, I should have known. Houses were going up so much, I should have known better. Therefore, I'll know better this time. Tech stocks, pets.com, what in the world was that? How could they be doubling their money every 3 weeks? I should have known better. I won't let that happen again. But that's a cognitive error. You can look back and say, really at the time, nobody knew better. But the others are emotional, overconfidence. I was told early on in investing, don't mistake brains for a bull market. I graduated college in 1998. I started managing money before that. I was an accountant before that. We managed money for other people. I was told, don't mistake brains for a bull market. I thought I was pretty smart. When you're overconfident, this is what we tell our teenage drivers. Don't be overconfident when you're driving. Same way with your investing. Don't be overconfident. Investing's really hard. If it was easy, engineers like us would be able to just never lose money and always give you positive returns. I don't know a manager, Warren Buffett. He was called washed up. He couldn't make money in the late 90s. Investing's hard. So don't mistake brains for a bull market. Self-control, we see this all the time, whether it's our spending or what we're doing with our investments. And we let short-term events, we look at 2014 and 15 and say, S&P looked pretty dang good. I know I can't risk that 43% downside, I'm going to jump in. And then finally, regret aversion. Nobody likes to be wrong. Especially if we have friends and family and coworkers who have been in the market and they keep bragging about how much money they're making. And you say, you know what, I might as well get in. If they go down, I'll go down. I'm tired of being wrong. That's that herding bias. Bubbles are formed because people all herd together and they start thinking the same thing. These biases are much more difficult to overcome. We can all fall for these at different times. That's when you have to be very careful and know yourself and know which ones you might be prone to. And then have a sounding board. That's where your financial advisor, like Peter, comes in. He's your sounding board for that. So that's really important. This is my favorite thing that I've learned in the last year, is these emotional biases, because I think, we look back at things, and most of our clients that came to us because they lost a whole bunch of money that was memorable to them. They said, I just don't want to lose anything else. And we didn't adjust their portfolios and say, yeah, but you're falling for this bias. The world isn't ending. We need to look at something else. We can't change that. We can only identify what we did wrong and then move forward with the data.